Thank you for joining us at XM.com for this Forex Preview video. The first U.S. CPI report of the year is out on Thursday. Forecasts point to a further decline in inflation, but it will be interesting to see whether and how this may affect market expectations of a Fed pivot this year. I'm Cristina Marujos. Joining me today is our senior investment analyst, Haralambos Pissouros. Haralambos, arguably we will see a further decline in the inflation rate in December in Thursday's report, while other economic data recently point to a slowing economy. So how realistic are markets' expectations of a Fed pivot right now?
Hello, Christina. Market expectations seem an important driving force for the dollar. What we need to start from is that the market has been stubbornly disagreeing with the Fed. Fed officials have been adamantly sticking to their guns, favoring raising rates above 5% and staying on hold thereafter. And yet, market participants see a lower terminal rate and around 50 basis points worth of rate reductions by the end of the year. Investors saw inflation coming off its peak faster than estimated, and perhaps they believe that this will continue. They may also be afraid that the already delivered interest rate hikes will weigh more on the US economy. On Friday, after the disappointing wage growth data, the ISM non-manufacturing PMI for December, basically referring to the services sector, slid to contractionary territory for the first time since May 2020. This came on top of further contraction in the manufacturing sector, and bearing that the service sector accounts for 77.6% of the US GDP, it may have added to fears about the performance of the US economy. So, yes, I believe that there are some reasons for market participants to keep the possibility of rate cuts on the table, but I also see them reacting asymmetrically overall. They are selling the dollar more aggressively on data confirming their view, but they don't buy with the same excitement when economic releases surprise to the upside.
And speaking of the dollar, let's turn to the market reaction, Haralambos. Earlier this week, we saw the greenback fall to 7-month lows. Therefore, how could it perform on the CPI report this week?
As I already mentioned, the market seems to be reacting asymmetrically. A recent example of this is that the dollar was bought last Wednesday after the ADP print beat expectations and initial jobless claims fell by more than forecast, but it was sold much more aggressively after Friday's official jobs report pointed to slowing wage growth, despite still suggesting decent employment gains and an unemployment rate matching its lowest level in the last 50 years. Now, tomorrow, both the headline and core CPI rates for December are expected to have continued declining to 6.5% year over year and 5.7% from 7.1% and 6% respectively. In contrast to the Eurozone, where underlying inflation continues to rise, in the US, underlying price pressures are cooling alongside headline inflation, which enhances investors' view that a Fed pivot may indeed be on the cards for later this year. And so this is likely to keep the US dollar under selling pressure. Now, with the ECB expected to continue tightening more aggressively than the Fed henceforth, perhaps due to the aforementioned divergence in underlying price pressures, euro-dollar could climb above the very important resistance zone of 108, which a move that could open the way for near-term advances towards the 111.75 zone, marked as a resistance by the high of March 31st. Now, for the bears to take full charge and the outlook of the pair to change to bearish, I believe that a break below parity may be needed, as such a move would also confirm the violation of an uptrend line drawn from the low of September 28th.
Haralambos, thanks so much. This was a Forex Preview. Thank you for joining us at XM.com.